The US Energy Information Administration, also known as the EIA, has a very bearish price forecast for crude oil. They think it will average just $51 a barrel next year. Currently, Brent crude is around $65. They're not the only ones with a bearish call. Goldman thinks crude will be in the low 50s in the second half of next year. ConocoPhillips is laying off a quarter of it. The EIA sees US oil production only down slightly next year. That looks odd to me, because I should think that if prices fall that far, there will be some pretty meaningful cuts in drilling activity. The White House wants higher oil production, and I'm suspicious that the EIA doesn't want to offend him with more plausible forecast, which will be down more than they're currently saying. There's also an interesting impact on natural gas prices, because the Permian wells in West Texas produce associated gas that comes out of the ground with the oil. A drop in crude output will also cut gas production. But gas is in high demand to generate power for data centers and also to supply our growing fleet of LNG export terminals. So it's a perverse outcome where too much oil supply will push up gas prices. I think the outlook for gas prices is strong. We're going to keep consuming more in America and sending more overseas as LNG. Chris Wright, our energy secretary, speaks a lot of sense. The Europeans want us to increase sanctions on Russia, but the EU is still buying oil and gas from them. They increase their imports of LNG mostly from Russia. The EU's biggest problem is that they don't speak with one voice. Most countries want to reduce Russian imports, but Hungary doesn't, and that causes a problem. The EU has agreed to buy $750 billion worth of oil and gas from us over the next 3 years. It's an impossible target, more than our total energy exports are likely to be over that time, but they should at least be replacing all their Russian imports with ours. I can't see the point in more sanctions on Russia if the EU is buying their oil and gas, enabling the Russian war machine. It's just pathetic, and they need to find a way to get every country in line with what's in their best interests. Chris Wright criticized the EU's, in quotes, exaggerated activist view of climate change, close quotes. I love that quote. It's like the left-wing extremists who have led the Democrat Party into oblivion with no money, with unmarketable policies, have been running things over there. He pointed out the steady divergence in wealth between the US and Europe because they're slowly deindustrializing with their climate policies, which have led to the world's most expensive electricity. All those progressives who claim renewables are cheap should look at the world's leading proponent of carbon-free energy for a reality check. It's great that this administration is taking a tough line on the issue. White House policies may not be the best for oil prices, but they're good for exports and they're good for natural gas. They're good for natural gas infrastructure, which is where we're invested. If you're interested in learning more about the energy sector and interest rates, then don't forget to subscribe and follow us on LinkedIn and Twitter. Our handles are in the description box below. To find out more about what we're thinking, you can sign up for our twice-weekly blog at sl-advisors.com. If you have any questions you'd like answered in this video, then please leave them down below. I'm Simon Lack. Thank you for watching this video.